Well, good morning. Dornbush download number 48. Hopefully going to do a bit better than Steve Smith and make it to the 50. That's a bit unfair, though. He's had a golden run, but what happened overnight?
He makes it look so easy, doesn't he? It's almost like he's out in the backyard just having a bit of a muck around, so to speak. But yeah, he just couldn't quite get there, could he?
I'm sure the Poms were pleased to see him off. But anyway, we're not here for cricket. We're here for Dornbush download number 48. And look, an interesting sort of week. The Chinese stock market again sort of dominating. I note yesterday it was up around 3.5% on strong government buying into the close. Reminds me a lot of the Asian financial crisis. You might remember when the Hong Kong government actually stepped in and bought around 15% of their share market and basically propped up their market. It sort of starts to have a little bit of that going on.
Yeah, enormous amount of government intervention, isn't there? I mean, you know, by far and away not a free market as we're sort of used to here. Yeah, you know, a lot of restrictions on buying and selling, and particularly during this latest turmoil, which really has been bubbling away for the last month or so. It's sort of captured headlines, I guess, now that Greece is no longer a topic of conversation. But yeah, it's just extraordinary, and you're right. I mean, the government's certainly throwing all sorts of ammunition in to try and keep it or stabilise it at least in the short term.
But the key thing that people should be remembering is here in Australia, the institutions, so the banks and super funds, make up around 85% of the market. Mums and dads make up about 15%. Shanghai, or you know, the Chinese stock market is inverted. So it's 85% mum and dads, only 15% institutions. So this movement is not being driven by institutional money. It's not a reflection of the economy. It's really, in part, you saw the number of share broking accounts go up when they cracked down on gaming in Macau. And people sort of went from gaming in Macau to buying the Shanghai Stock Exchange. So we're not reading too much into this from a broader read of the Asian economy. And in a couple of weeks' time, we'll be talking to you about a new float that we're doing, which actually focuses in particular on Asia. But anyway, we'll get to that. So, Michael, what have you been buying this week?
Yes, Andrew, just been following a recent listing, a company called Amaysim Australia Ltd, AYS is the code. Basically a mobile virtual network operator and a mobile network operator.
They're the biggest. That too quickly?
Yeah, so you get a bit tongue-tied there. They're the biggest mobile virtual network operator in Australia.
Oh, really? Bigger than like Virgin Mobile and all those guys?
Yeah,
wow.
Yeah. And the fourth biggest mobile network operator behind, you know, the likes of Telstra, Optus and Vodafone, of course. So yeah, recently listed, came out at a float price $1.80, currently trading $1.96. So the market's been pretty keen on them, crunching a few numbers, you know, and weaving a bit of magic and all of that sort of stuff. Discounted cash flow brings them out at about a $2.50 valuation. So certainly one to keep an eye on, particularly too if you're looking at that mobile sort of phone, direct mobile phone. There's no sort of internet or anything like that within this particular company, so it's just pure mobile phone exposure. Mobile phones, of course, you know, particularly now the 4G devices, mobile phone sales are just going through the roof, and they're of course closing off a lot of the old, the old second generation, the 2G sort of slowly being unwound. So yeah, one company that we're looking at, a little bit on the spicy end, but having said that, you know, it's making money. It's about a $350 million market cap.
So it's not too small.
Yeah, going to pay, well, a guesstimate dividend of about 4%. Price earnings a bit high, about 37 times, but the earnings per share growth at about 52 times. So that you know, that price earnings growth ratio under 1, which you know is sort of the magic number, I suppose. So yeah, certainly one to keep an eye on.
And if you look, you know, Telstra's obviously been very kind to people from a dividend point of view, but there's been a number of other sort of smaller telco ones listed that have done pretty well. MTU, MT Telecommunications, TPG is one that we like as well, and looks as though they might give Telstra a good run for their money as well. IINet, which of course has just recently been taken over. And a lot of those smaller, well, not that those three I just mentioned are small, but relative to Telstra they're small. That smaller end of the telco market is still continuing to grow. Everyone's got at least one mobile phone, some of us two. So, you know, from the point of, and people's insatiable appetite for data, for Facebook, you're a mad Facebooker of course, people's insatiable appetite for data. And you're right, the faster these networks get, the more money they're making, because people don't consume data on the amount consumed, it's on how long they're on for. So the longer they're on for and the faster that data's coming in, the more data that's being used, the more money these telcos are making. So sounds like an interesting one.
And this is it. And you mentioned, MT Group, or M2 Group rather. This company, reading between the lines, is very similar in a lot of respects to MT Group. It's really a reseller. And of course, their price has gone from, well, it would have doubled in a bit over the last few years.
So. My Netphone's another one, MFN. So I like that one. Thanks, Michael. Yeah. That's a goodie. In my world, and look, we've been going for a while, so I won't labour the point for too long, but healthcare is a space that we've been looking at a bit more. Healthcare's been the best performing sector for the ASX. I think it's up about 10% so far for the year, in what's in essence been a relatively flat market. And the ones that we've been looking at are things like CSL, things like Ramsay Healthcare, things like Certex, and again, talk about ones at more the spicier end. One that we've been looking at is one called Capital Health, COJ, and I think we've mentioned them once before. They're a diagnostics company. They're the 4th largest in the country, very strong in Victoria, moving into New South Wales. There's a lot of government support there. From a revenue point of view, they're growing revenue pretty strongly. Share price, which was about $1, is now back at about 70 odd cents. So again, probably a little bit more at the pointier end. You're not buying it for dividend, but if you're looking for exposure to that healthcare sector, certainly those other ones that I mentioned, in particular CSL, in particular Ramsay, if you're sort of more at the conservative spectrum, and then if you're more at the spicier spectrum, you might look at things like Certex, or you might look at things like Capital Health.
Yeah, it's funny, isn't it, Andrew? I mean, we've been big fans of CSL for a long time, and I think they're upward of $97, $98 today, and it sort of throws a few people off, doesn't it? Paying that type of money for a share, but the performance of the company's been outstanding, and look, that earnings growth will just continue to drive the price beyond 100, and
and you're right, because of that strong offshore earnings, and you've got the same with Ramsay. They're buying back their own shares, which is always a big positive as well. Again, it's not, none of these healthcare ones are great dividend payers. You're putting them more in there for earnings growth, and you're hoping that earnings growth translates to an increase in share price. But I'd certainly say, I know my own clients' point of view, they've probably been a little bit weak on healthcare, but you look at overseas trends equally. Just because healthcare's been a strong growing sector here in Australia, it has been offshore as well, and there's no reason to think with an ageing population, increasing government support, etc., that wouldn't continue into the future.
Yeah, thematics look very strong, don't they? Absolutely.
Anything else you wanted to cover off?
Not really, Andrew. No, we've had, I guess, the unofficial start of the reporting season today. GUD Holdings is typically number one off the rank. They're up about 7% at the moment. So I had a brief look at the figures. Dividends are up by about 20% on the same time last year. So that's market's obviously liking that news, but certainly reasonably strong underlying profit growth as well, up around about 20%. So, looking at that as a standalone, it's a good way to start, no doubt about it.
Because there is a lot of concern about profit reporting season, and it's not necessarily a bellwether, but by the same token, if that was a poor one, it's not a good way to start. So it's great to see them starting off well.
Yeah, absolutely. We've had a few disappointing sort of downgrades in the last few weeks, so nice to see a bit of upbeat news on that front for sure.
Otherwise, Michael, you're all done?
All done, mate.
I'm all done. Till next week. Thank you.
Thank you.